All right, so oh no, not again. All right, so we're in the excuse me. I had to pause that. It's kind of tough. We're in the I think we're in the early stages of a global economic recovery. We're going to go over that data. We're going to check out J.P. Morgan's piece on the 2024 outlook and Citibank's outlook on 2024. So yeah, we'll do that, and then once we go through their outlooks, we will dive into my outlook, and I'll show charts. We're going to throw the charts up and kind of walk through how I see 2024 playing out. I think it's pretty bullish. A lot of people don't see it, so let's get started. All right, so first let's take a look at JP Morgan. This is JP Morgan Research 2024 outlook for the economy, how they see stocks. They're pricing in a soft landing. They're looking at a mild recession. So they're talking about a mild recession here. Too early for a victory lap is the headline for JP Morgan. So let's go ahead and go through it. I got everything highlighted so you can see what I'm focused on. So first and foremost, these are the most important pieces, I think. US total spending on interest payments has picked up. Delinquencies on auto and credit card loans are at the highest levels in 10 years. So that's kind of why they believe we're going into recession. They have a little chart here, which we will go over a little later on, basically how this is mortgage debt going higher, but they are focusing on how non-mortgage debt, right, corporate debt has been spiking, and those payments are going to be due at a high rate going into 2024. Okay, the amount of corporate debt that will have that'll have to be refinanced at high rates starts to pick up more substantially over the next 2 years, and we got a response for that. We do have a response for that in the charts when we get to it. Fiscal spending in the back. So here's where growth starts to reaccelerate. We're also focused on Europe also. And I see you in the chat. You'll see the recovery. You'll see the recovery. I know it sounds crazy, but hey, everybody's predicted that the stock market would go lower, that the economy would fall off a cliff, and it hasn't happened yet. And if anything, growth is still, staying above trend and maybe slows down in Q1. I think that is the case right now. So fiscal spending, right? Multi-year, multi-trillion dollar stimulus programs, which we've talked about, the CHIPS Act, the Science Act, or the Chips and Science Act, the Jobs Act, Infrastructure Bill, and the Inflation Reduction Act, that's in the US, has kept growth afloat so far. Now for Europe, right? Europe is in recession or entering recession or near recession. China is recovering, they're struggling. Japan's recovering, they're struggling a little bit. The US has been doing better. But they're focused on Europe here because we do know Europe is the weakest economy going forward of the large economies, right? And so here's a key indicator. Their European Recovery Fund, which is their large stimulus from the government. This is a key for me, which is 65% of the funds have not been dispersed yet. So they still have a lot of fiscal stimulus to be dispersed into their economy. When does that happen? We'll go over that. I think it's going to be during their election cycle next year. All right. So coming down a little further. And then this is what they say about the spending, though, why they don't think that spending stimulus really helps out too much, or it's not going to happen, because a 6%, well, this is US, a 6% budget deficit in the US basically means whoever ends up running for president, that's a huge deficit in 2024, will not be spending on the promises of major tax cuts or any major bills. I doubt it, because of the high deficit. So basically, they won't be able to spend, right? They won't be able to print money. And that is a discussion or a disagreement between a lot of people, because some people just say, well, the Fed will start buying back debt again. All right. Who knows? All right. The fiscal promises of the successful party are often key to how markets react. For example, and this is why, if this does switch, if we do get fiscal stimulus, it's going to be very stimulative to growth and earnings for stocks. Back in 2017, the last time we had a tax cut, it was a Trump tax cut. 2017 fueled a strong market rally and wave of earnings upgrades, right? So earnings moved higher also. However, and this is kind of what they're stating, the limited fiscal headroom because of the deficit in the US and the UK will likely make it difficult for any party to deliver further tax cuts or major spending programs. Maybe not tax cuts, maybe so, but spending for sure in some shape or form, I think is going to come. All right. Now we'll scroll down a little further. There's a lot of information on here, but I'm just highlighting the main points that I saw. Okay. And I actually have this in the description. If you're on YouTube, you can read it yourself. You can go check it out if you want. I have the Citibank research for 2024 and this was actually interesting too, and the JP Morgan research. This is about cash. Cash is unlikely to be the best option, they believe, going into a mild recession, because first of all, if you have a soft landing, let's just go through the scenarios. If you have a soft landing, then cash rates, or the Fed funds rate, is the same or a little bit lower. So stocks are going to do much better, right? Cyclicals are going to do better because it is a soft landing. Growth doesn't fall off a cliff. If we do go in recession, cash rates are lower, the Fed cuts rates, so cash isn't that attractive. Money market funds drain and probably go into bonds. Stagflation, this is the worst case scenario, right? For stocks and bonds, but good for cash. Cash rates start to rise because the Fed has to increase rates, or keep them where that they probably increase rates. I think this is the most unlikely scenario here, but cash does outperform. You're getting 5.5, maybe goes to 6.5%. Very unlikely given the forward looking indicators, right? So this is their base case in general, right? Base case for JP Morgan. What they see is weaker growth. They see weaker growth in 2024, which helps to push inflation back towards central bank targets. Okay. Back to that 2.5%, 2% target. Interest rates are eventually cut, right? So that's pretty bullish, but you might get a slowdown in the first half. When it comes to markets, they see a downside for stocks and a positive environment for core fixed income, just another word for yield or bonds or the bond market. And they are advocating for this is going to be more towards bonds because they are bullish on bonds. They're advocating for bonds. Goldilocks is what, a lot of analysts are saying we're in now, where growth is starting to reaccelerate and inflation is falling. This is the best case scenario for stocks, stronger. And this is the growth that we are seeing is coming from productivity, right? So this is the best type of growth because it absorbs inflation. You can grow without the inflation rate actually picking up. And this is due to labor participation. We've seen that go up, and a lot of that has came from immigration. More of that labor growth or participation is coming from non-US citizens. Interest rates are slightly lower, right? Great for stocks. The strongest scenario for stocks is the Goldilocks scenario. Small caps outperform because they're interest rate sensitive. Those interest rates come down. They're already under positioned. They go much higher. Not great for bonds. Bonds actually stay range bound, which is not too bad for stocks because you have predictable rates, right? Soft landing. The Fed is so they say that the market is predicting a soft landing where growth remains pretty stagnant, right? Stagnant growth. I guess we do see. I think we do see stagnant growth in Q1, maybe Q2, below trend. So growth below trend. Inflation does fall back to 2%. Interest rates are gradually lower and go back to neutral, right? So interest rates are lower also. I still think that's bullish for stocks, depending on what stocks you have, right? Maybe not the whole equity market, but stocks that don't have to adhere to higher rates and can still grow their earnings, thus the Mag 7. This scenario appears to be most aligned with current market pricing. And then stagflation, that is your worst environment where growth falls, growth decelerates, but you actually get inflation picking back up. This would be the worst case scenario. Stocks sell off hard. Everything sells off hard because you have to start hiking again. You have to start reaccelerating your hikes. You crush growth, you force a recession, and basically go into a deeper recession, right? So that's the JP Morgans, and they also signal. I think 40% of the countries on Earth have an election, right, coming up. I wasn't going to focus on that too much, but you have a giant election cycle: Pakistan, South Korea, Taiwan, Indonesia, India, and then over here in the West, the U.S., Mexico, and in the Euro countries, Russia, Ukraine, South Africa, the EU, and the UK. So there's an election cycle coming. And to me, that spells more stimulus coming from governments, right? To reaccelerate from the slower growth. Now let's switch over to Citibank. They're a lot more bullish on stocks than JP Morgan is. They are a lot more constructive going forward. All right, let's broaden this out a little bit so we can see it. Okay. And I'll just scroll down to their highlight. And what they say is they see slow and then grow, right? slow and then grow. That is their outlook. Three distinct phases of market activity since the start of the pandemic. So they're going back to the pandemic to kind of highlight how this engine it has been going and how it goes into the future. So we have the stimulus driven euphoria from 2020 to 2021, and then next the bear market of 2022 to 2023, and now they say we are entering a period of normalization on rates, on inflation, and growth in 2024 to 2025 are exiting a period or they see growth and we're exiting a period of rolling sector recessions, right? Rolling recession. We've been talking about that. There is a rolling recession. A lot of people don't believe there's a recession and it comes later, but I'd argue with a lot of statistics here and a lot of evidence, we've been in recession, right? We've seen it in the manufacturing, the industrials, in the housing market. We've been in a recession. We've been frozen. The tech companies had a recession in 2022 where we had all those massive layoffs. And so what they're seeing is rolling sector recession and unusual levels of employment demand to begin a global economic recovery. So there's a lot of demand for employment, and AI will take artificial intelligence or automation will take some of that labor and create more labor supply, keeping inflation pretty much at bay. We see corporate profits rising. Now, this is the bullish part in 2023 to 2024. We're already seeing that at 5% at a 5% rate and then a 7% rate from 2024 to 2025. We expect the US Federal Reserve to lower rates at the short end, which is going to boost activity. We see inflation running about 2.5% by 2024. So they don't even see the Fed getting to 2%, but nobody really believes the Fed needs to actually get there. And then they talk about the big reset. This was very interesting. They said that there was a big reset and everybody was waiting in 2023, right? Including, probably a lot of you guys watching, you see it on CNBC, you see it and on Twitter, wherever it is, they're waiting for the blessing of a deep recession, right? Because a recession provides an all clear. Okay, now it's time to invest. Now it's time to get going. But they argue we already had a rolling recession and we're actually starting to recover here. And yeah, that's basically their outlook. I mean, there's a lot of pages of data here, but I'm going to go over my outlook, which is a little mix of both. Obviously, I'm a little more bullish, but let's dive into that. Let's take this off. And before we actually get in, don't forget to like, subscribe. I'm going to flip over to the markets really quick because S&P did hit all-time highs. No, not S&P. Oh, wrong chart. We had not S&P. We had here it is. We had Qs. No, this is not it. Too many charts. There it is. We had the tech, and I'm keeping an eye on Tesla here. I think Tesla's a great opportunity starting to break out of that level. But moving over to the Qs, right? The Qs just touched all-time highs. NASDAQ touched all-time highs. NASDAQ 100. I don't think NASDAQ futures are up, but NASDAQ did barely touch all-time highs. I mean, the RSI is pretty overran, so everybody's expecting that pullback and a correction, which will come at some point, but it could really start to rally, squeeze the shorts, and then come back. But it's in a pretty sharp uptrend for now. And if we do move to the weekly chart for the Qs for tech, I mean, that is a very strong chart. You're almost waiting. You almost want that pullback. But like I've said before, we could be in overbought territory for a while, right? And this causes the run up where it just sticks up there. There's a lot of momentum going in to the index because, we're at all-time highs. And that is the marker for a lot of people, a lot of investors, a lot of fund managers saying, okay, this is the bull market where we get to all-time highs. That's a huge recovery, huge upside recovery. So we might have more room to run. Who knows? We'll keep our eye on that going forward. All right. So that's the Qs. Now jumping over, let's see, what is the best way to look at this data? Actually, I'll just pull myself down here and then we're going to go over the charts that I have up so you guys can see, you can read and make sense of the information. All right. Now, first and foremost, we got this housing market momentum picking up. We saw the home builders yesterday, I believe, the sentiment start to pick up for home builders, right? So I think the housing market momentum is now starting to pick up due to the Fed communicating, hey, we're looking at 3 rate cuts, maybe starting in March or May in 2024, which is going to increase the confidence for multifamily builds, for single family homes. And so you're seeing housing market. This is a housing start. So new contracts going forward. they are now starting to build. And this wasn't necessarily because of the Fed, last week, because this is lagging data, but I think this continues. We see more of it because there's an incentive to start building. There's an incentive to get that market going. This might actually get prices lower. So before we actually get there, I actually want to let's go over this piece first. This will be part of it. Let's go over this piece about the housing market, about some momentum. We have an analyst here. See if we can see this. And he talks a little bit about the momentum, the new home constructions, because the housing market's the real estate's been in recession for a while. And if we do get that recovery, that's late cycle. A lot of people argue we're in late cycle, everything's going to collapse. But if the housing market is recovering, that's a signal that we're in early cycle because it is the most lagging market. So we're in early cycle. Stocks are already up because they're looking forward to 2024 earnings, to lower rates, and to more normalized inflation rates, right? So let's turn this up and then we'll listen in to what he has to say. And I'm going to throw my 2 cents as we go.
Nice to see you.
Nice to see you as well.
How much activity does a move in mortgage rates from 8 to 6.5% unleash?
Well, we see over cycles that buyers react more to the change in the mortgage rate than the actual mortgage rate itself. And it suggests that next year will be a very good year.
Okay, you guys heard that 8% rates down to 6.5%. That is a gigantic move. That is what's stimulating the housing market. A lot of people say, hey, we'll really get a boom if we get to 5.5% for mortgages, but 6.5% is going to stimulate for sure. So just keep that in mind. That's a 100 basis points, 150 basis points. That's a big drop for the mortgage market.
A key question is, will the Fed lower rates in the March meeting before the spring market or in the May meeting afterwards? Look, 2023 was the worst year in transactions since 1993. And for the first time, all of the key metrics on the inventory side and the buyer side are pointing the right direction. We have 4% more inventory ending the year than we did last year. So inventory is building. And again, buyer demand was high, even with 8.1% mortgage rates. And now,
so supply is coming online. We've talked about this, more multifamily supply coming online. And when you get that supply, what happens? Prices can ease as long as it meets the demand, right? So you've had a lot of demand, you probably get more demand. Maybe prices go nowhere, but the inflation on it should start to slow down, especially with multifamilies picking up.
Now at 6.5.
What's driving the inventory? People finally feeling like they can sell?
Yeah, look, sellers are adjusting to the new normal. And you can only hold back the life events for so long. We've talked about the 5 Ds, diapers, diplomas, diamonds, divorce, and death. That keeps the market moving, and it forces inventory to be brought to the market.
Not that much, though. I mean, it's still at the margin, but it feels like that flood of actual sellers or at least creating a market that would allow buyers to really benefit is not there yet.
Yeah, that's a very fair point. We're not seeing a flood of inventory, or just a modest amount of inventory. 4% more than last year off depressed levels isn't that great. And although it's 4% more inventory than this time last year, it's 39% less inventory than 2019 before the pandemic period. So very fair point. But after a period like 2023 of meaningful contraction, this does suggest that 2024 will be modest expansion because more inventory equals more sales.
We've been through cycles. We've been through this part of the cycle before, though, but not where work from home was as universal as it is. Does that make this one different than past cycles?
Yeah, work from home is also a modest catalyst to movement because CEOs realize that you can't build a great culture virtually. And if you can't have a great culture, you're not going to have a great company. So they are slowly bringing people back to the office. And those boom towns, which benefited from the work from home era, are slowly bringing inventory to the market more than others.
So what is hot? Where do you see the most demand?
The hottest markets are what we call the spillover migration markets. Now, those are markets that are adjacent to core markets that are becoming too expensive. So San Francisco, people are moving from there to Sacramento, from Austin to San Antonio, from DC to Raleigh.
And what about rents? I mean, I know, but that's, it's a component of your overall business. We have started to see declines. What are your expectations as we move through 2024?
Yeah, in this period of inflation where rents are a big contribution to that, a big factor, one of the best signs we're seeing are around rents. Rents have declined every month for the last 5 months. We saw in November the sharpest decline in 3 years in Manhattan, which has seen 27 months of rental increases, saw the first time a rental decline.
Why? Because inflation is coming down finally?
Yeah. We're seeing deflation in the rental market because there's too much inventory on the rental side.
You're going to hire more people next year to get ready for this actual increase in business, or you're okay?
Look, at Compass, we are committed to keeping our costs low, even when the market does come back, so that we have meaningful expansion in EBITDA, which we can share with our investors.
All right. So we'll get off of that. Basically, housing supply, the housing market is slowly starting to recover, right?
New Year's
And
resolutions for investors.
so a lot of people want to wait till things fully recover to actually have some positive sentiment, but we do see these leading economic indicators that tell us that, hey, housing is starting to recover. And the biggest factor there is really the fact that the Fed is now done hiking, right? The Fed is done hiking. Bond yields have came down. So let's take a look at that. This is what leads the mortgage rate market, where the mortgage rate market leads actual activity. So if these borrowing costs are falling significantly, they still have a ways to go, maybe get down to 3.5 because growth is slowing. Then this leads mortgage rates, right? This will lead mortgage rates lower. There goes housing activity starting to pick up, which is where we come and we take a look at the data that we're getting in. And we just looked at this. The momentum is picking up, right? New starts or housing starts are starting to pick up. They actually beat expectations this morning. All right. Now, what keeps us there? Inflation. We looked at this yesterday. PPI, producer prices are lower. CPI is lower. The inflation war is pretty much over. So now we turn to Europe, right? This is where I see the global economy starting to recover, because China's already stimulated. Their inflation rate is near zero. Our inflation rate continues to improve lower. Now Europe is finally getting down there. I think it was at 2.5%, 2.4 headline this morning. Their core is at like 3.7, but it's still falling. So you get that disinflation in Europe. And the reason this is key for the macro is because GDP in Europe is at zero, right? Their GDP growth is zero. So they're flirting with going into recession. But as J.P. Morgan and the research pointed out earlier, right, the EU recovery fund, and think about it, we're going into an election cycle. If GDP is low, if inflation is done, now you can start stimulating, you can start, boosting the economy because inflation is down, and it doesn't cause inflation necessarily to climb because it's an inflation rate, but it maybe gets stuck around that 2.5%, right? So 65% of the funds or fiscal government spending is still waiting to be unlocked. Once that does get unlocked, now you get a recovery in the European Union, and the U.S. is already starting to recover, and then Japan's recovering, China recovers, and then you're good there. Now, what are some of the leading indicators, right? The most leading economic indicators are going to be the manufacturing cycle for Europe in the Euro area. Well, they're in a recovery phase. If you go back to 2012, after the European debt crisis, the PMIs, the Purchasing Managers Index, which is the most leading economic momentum indicator, it started to rise, right? It bottomed out and it started to rise. And we're seeing that now. It's been climbing for a couple, I think 3 or 4 months. The manufacturing cycle is recovering. Now, services are already positive. So you're just waiting for that recovery. I think we're in the recovery phase for Europe, which signals a global recovery going forward. Does it happen next week, next month? No. But over the next 3 to 6 months, markets price in the recovery. They don't wait for the recovery. They're forward looking. They look 12 months ahead, right? Now, corporate debt. This is going to be a lot of people's issue. Well, corporate debt is so high. The amount of corporate debt has to be refinanced over the next couple of years. And, stocks are going to really struggle. Not so much mortgages, because a lot of people are locked in at 3.5 already, right? It's a 15, 30-year mortgage, but the corporations have to refi, right? First of all, 50% of corporations, well, S&P 500, they don't have to refi till 2029. So you're talking about the bottom tier, the bottom tier lower stocks that have to refi. But what did we just get from the Fed? Right? What do we just get from the Fed? That they will be cutting along the way to 2%. They're not waiting for 2%. They'll be cutting on the way down. And I wish I could show that. I wish this StreamYard needs to get it to where I can put my mouse on there. But either way, in black, 3.5% in 2025 is what they're looking at. So if rates are coming down to 3.5 for corporations, well, I mean, bond yields are going to be down much further than that. What does that tell you? That they can now refi back at normal levels, and there goes the evaporation of your debt cycle, right? There is no huge, massive collapse in real estate or collapse in corporate debt, because in 2025, going into 2025, those rates are coming down. Therefore, the soft landing, right? There's your soft landing. And if we look at commercial real estate standards, tightening standards, they're starting to ease now. So you're actually getting an easing of commercial real estate loans. An easing, right? The cycle is over. The cycle is over. The tightening cycle is done. It peaked back in March of 2023 when the banking crisis actually hit us. The Fed stepped in. So now that easing is coming down. And now that inflation's down, we can project that we ease further from here. But it's not clear yet. We're not clear yet. Why? Because there is still some, I would say the most worrisome debt is consumer credit debt. But as long as we have jobs, as long as the employment picture is strong, which it is, you're really not going to see that. Okay. Now for S&P, actually, let's look at employment, right? For the US at least. Jobless claims, the most leading indicator for the employment market. Okay, jobless claims are going nowhere. There's just consolidating at the lows. You're not seeing a spike in jobless claims, even though people say, oh, jobless claims are rising up 10,000, whatever. It's not really happening. And that is a signal that people have jobs, or they're working, or they are finding a job. If they get fired, they get laid off. There's always another job somewhere. And we see historic high job openings, and they are coming down. They're closing the gap, but there's still jobs out there. And also the gig economy, right? Uber, Lyft, DoorDash, Grubhub, YouTube, content creation, OnlyFans. There's all these gig economy jobs, also construction for these multifamily builds. So there's jobs out there, and we're not seeing that spike. It's just not coming in. And if we look at payrolls, they are falling, right? But they're not going negative yet. You're getting a slowdown, and we already projected this in Q1, half of Q2, that we do get that slowdown. Unemployment still at record lows, right? Still at historic lows, under 4% unemployment. So I think it ticks up to 4.41. The Fed is expecting 4.1% unemployment in 2024, but that's not a huge uptick, and we'll see how that plays out. Now S&P earnings are due. Look at the blue. Focus on the dark blue. The dark blue, the first bar is Q3. So Q4 is set to slow. Earnings are set to come down in blue. These are the new estimates. But you get the rebound in the second half of, or the first to second half of Q1 for profit margins when it comes to S&P 500. And from there, margins or profit or revenue continues to climb. So stocks are already looking past this slowdown into the mid 2024, plus the election cycle, where we saw there should be a lot of spending in the election, right? Now, historic rates. A lot of people say, well, rates are just too high. Stocks can't grow. In white at the top is NASDAQ. Let's just focus on NASDAQ, because I think we're looking at something akin to 1994 to 98, which was the technology boom, right? We had a lot of e-commerce stuff coming out. There was a lot of new, it wasn't fully developed, but tech really started to boom. This was after the savings and loan crisis in 1991. And we started to recover. And I think we're looking a lot like this. So the reason I put this up here is because Fed rates were above 5%. Bond rates were above 5%, which are interest rates for the market. But the NASDAQ still moved 275%. Now, I'm not saying we get a 275% upside move from here, because the NASDAQ is much bigger than it was in 95, but it can still move because technology solves problems, and technology starts to eat up most of the growth areas, and it's transformative, right? So we have that. Now, moving on to leverage. This is why I think it's going to, once we get above NASDAQ hits all-time highs, and we get a little consolidation, well, take a look at this. This is leverage versus the stock market, okay? So in the purple is stocks, that is S&P 500, SPX, and in blue, we saw the largest drawdown, by the way, in margin debt history. So this is fund managers, retail, whatever you want to call it, leveraging up on margin to get leveraged into stocks, whether it's trading, investing, whatever it is. And those hit the lowest levels. This was the largest drawdown in debt. And now we're just starting to see that leverage come back into the system. So we still have a long way to go. There's still a lot of cash on the sideline to come back into markets to chase premium stocks, to chase debt, to chase corporate debt or bonds, whatever it is. So that leverage is at low levels, which tells you that we're under positioned. The market is under positioned at the moment, even though we're still moving higher. And again, more momentum indicators. The only central bank who has not really stepped up their stimulus is the EU, because they've had the higher inflation rate. But Japan, the Fed, well, recently the Fed, Japan, and China, they've had low inflation rates. So when your inflation rate is that low, that opens the door for more stimulus, right? And so we've seen that fiscal stimulus, like we talked about earlier, monetary stimulus coming from the RRP, which is shadow liquidity for the Fed. And now we're looking at the EU. That's the last shoe to really pick up. And once it does pick up, well, I mean, you're getting a global reacceleration. As you see, the manufacturing cycle in the EU is already bottoming out. So this is the rise underneath the hood that most people just don't see on the news, because it's a little deeper macro, right? It's a little more deeper macro. You just see headlines, delinquencies are at all-time highs, blah, blah, blah. But guess what? As opposed to when it comes to actual income, right? It's the ratio between debt, mortgage debt, and income is actually very low. So people will keep spending. And when you add it all together, global liquidity is still picking up. The global liquidity cycle with the ISM or new orders is your trigger that we're moving higher. So all those, all that tells you that we're, well, me anyways, think for yourself. You have your own opinions, whatever it is, but this is the data that gives us the soft landing for 2024, and it kind of shows us that we can rise. Now, if there's geopolitical risk, obviously that's going to be different. If we have geopolitical risks start to step up, there could be a black swan event. So this is excluding any type of black swan event, right? Thank you, Dimash. Appreciate it. Shout out to you. What up? What up? What up? All right. So back to markets. We do have interest rates coming down. This is fueling stock markets. This is fueling crypto or small caps in general. And as you get the dollar start to decelerate, as we've said, I think we have a rally all the way through down as the dollar comes down here. So as the dollar falls, that's going to be stimulative to the market, because everything is priced in dollars. Dollars go down, then the dollar is the denominator, the numerator goes up, right? The number on top gets bigger, which is the stock market. Or any other asset class, right? That you're looking at. So that is what we're looking at there. And oil had a nice bump today. Oil had a little bump, but what do we say about oil, right? Let's go to the daily chart. We talked about this. Well, oil is going to rebound. It's extremely oversold. It's starting to rebound down. It's starting to rebound. I wouldn't even look, not financial advice, I wouldn't be trying to get long oil. You could get long and play it back up to resistance, but we're expecting the Saudis to flood the market because they've given up too much market share. And plus with the slowdown, once travel season is over after Christmas, after New Year's, well, there's not going to be a whole lot of demand for, you might get demand back in maybe March for, excuse me, what is it? The holiday in March. So you might get that spring, right? Spring is a new holiday, so you might get that. But for the most part, supply is at all-time highs, right? U.S. supply all-time highs. A lot of the non-OPEC countries are picking up their supply, so I don't really expect this move to last too long. But maybe we come up to 80, possibly that 80 level. Maybe we run all the way back to 84. That would put upward pressure on CPI, and then that the market will stall out there. But I don't see that happening. Same with nat gas, got absolutely destroyed. So energy prices are pretty low at the moment. All right. And let's see what else we got here. VIX still pretty low. So, this will probably stay down here for a while unless you have geopolitical risks. I know there was a little bit of stuff going on today, but if it doesn't materialize, it doesn't materialize. And remember, everybody was like, oh, the war in the Middle East is going to spike oil. It just didn't happen because there's too much supply in the market at the moment. Way too much supply. All right, so switching over to S&P technicals. Let's take a look at the technicals. You can see here on the daily that we became oversold, and I think again we're gonna do something like we did back in that summertime rally, right? This was that summertime rally back in May. We get above, we get a little above, we hold up there, and we start to move. So I think we just stay a little. I mean, it's going to come down for sure. It'll come down. But historically, once you get in these, once you get here, price doesn't fall too much, right? This would be like from the pandemic bull market. price can still move up. You don't really drop below the RSI. RSI isn't going to tell you the future, but it does tell you where buying pressure's at, where selling pressure's at, and there's a lot of buying pressure. When the RSI is this high, when there's a lot of demand for stocks, that's very bullish. That's not bearish. It's different than RSI at the bottom because there's always a bid in the market. 401ks every month are buying into the market. So it's not the same down here. When you're up here, you're still getting, bids into the equity market consistently. And now you got breakout traders trying to play this breakout along with funds having to switch over out of cash because rates are coming down. So a lot of the fears have just disappeared. Not completely. There's still cash on the sideline, but this could be another face ripping rally if we get a little longer consolidation here. I think we need a little longer of a consolidation before we actually get the face ripping rally. Okay. And then again, tech, I think tech does lead where, shoot. Yeah, tech is moving up. That's pretty vertical though. That is very, very vertical. It's not moving too fast. It's just slowly melting up. And we said this, we're probably going to get a slow melt up. And that's what we've got, a slow melt up day by day. You get pullbacks, you get buyers step in to those pullbacks. And a lot of the, targets are at all-time highs at this point going into December. And now you have small caps, which are the most interest rate sensitive, probably outperform the big caps because interest rates, like I said, are like the Fed, communicated, are due to actually slow. So this is good because they can grow. Small caps will grow in a slower growth environment, typically because borrowing costs are lower. Borrowing costs lower is going to boost liquidity into this market. So you definitely get those bids coming in there. And then moving over to gold. Yeah, gold is struggling. I'm not really a believer in gold like that. I'm just not a big believer in gold. I think it's a good, it's okay hedge against monetary inflation, but we all know the better hedge is going to be tech stocks against monetary inflation, against Fed, cutting rates and all that. And we do know that Bitcoin outperforms. So gold is a good proxy. I mean, if you're a Forex trader, of course, gold USD should do pretty well. Outside of gold USD, though, the gold is not your fastest horse in the race. Definitely not the fastest horse in the race. Bond volatility is coming down. So the spread on treasuries is coming down. That's going to help more, more debt buying in the bond auctions. So as long as this stays low, this is probably the more important volatility indicator. You want bond volatility to remain low. And then the volatility VIX basically rolling over. So the trend of volatility is pointing lower. That's a bull market. It's pointing towards a more secular bull market here. Put to call ratio, I'm not sure where that's at. And that's what we're looking at here. If you look at the banking index, KRE, it's now breaking out. You have that trend going higher. So this is regional banks. Regional banks recovering are a huge signal for IWM. I think this is the biggest index in the small caps, is the KRE index. So within small caps, regional banks recovering after the big crisis. This was a crisis where the Fed pumped money. So if you do get a real estate crisis, you'll see the KRE roll over a bit because most commercial real estate is on regional bank balance sheets. But what happens? The Fed comes right back into the market and starts to simulate again. How many stocks moving above their 50-day moving average continues to climb. Very bullish market. And I think that just, we should have some consolidation, but it probably continues. Semiconductor ETF still at all-time highs. Let's go to individual stocks. I think energy is starting to slow down a bit. XLE. Yeah, energy is not doing great because obviously energy prices are down, right? Nat gas, oil prices, they're down. It looks like a nice wedge, but the governments are going to do whatever they can to make sure energy prices don't spike. That's typically how it works. And then I think real estate is now recovering pretty sharp. Look how sharp the real estate sector's recovering, and this should continue because you see that in the home builder ETF also, because rates are projected to come down. I don't know how many times. You got to get this through your head as an investor or looking at the macro. The markets are forward looking. So they're anticipating, they're pricing in Fed cuts. They're pricing in cuts. Even if cuts don't happen, other segments of the market can still move up. But the real estate market is now getting bullish as rate cuts are set to continue going forward. Retail sector, I think this slows down because retail. I don't think retail does too bad. Anyway, let's go to individual stocks. Go back to the S&P. Let's go with tech. How's the Dow? Dow still at all-time highs. Dow just continues to make all-time highs. Very strong. Very strong. I don't know how far it goes, but let's see. Where's that measured move on the Dow? Does anybody care about the Dow? I don't really care. I just use it as a barometer for market breadth, right? Which is how many stocks are being bid up. Typically, you get somewhere between the blue and the red. So Dow on its way to 400, maybe like 390, but the Dow should continue higher. With the slight slowdown in Q1, Q2. That's what we're anticipating, a slowdown in Q1. ARK Invest is now breaking out. ARK with the most explosive stocks. I mean, they call this the future of NASDAQ. This is the future of NASDAQ because it has the most innovative companies inside of it who don't have the best earnings. But now that rates are coming down, bond yields are down, and the Fed is expected to cut, not because of a recession. Well, ARK stocks are starting to really move up, and this is going to put higher pressure this is going to put up buying pressure on Zoom, on Robinhood, on SoFi, on Roku, on Tesla, mostly, I would say mostly Tesla, because ARK is an ETF, right? Apple is, we think Apple slowly climbs higher, biggest stock on the market for sure. And there wasn't an actual iPhone ban. I think China was talking about banning Apple Watches, I believe. So we'll see. Apple still has a lot of ways to make money. And, they have 90 billion, 100, who knows how much cash they have on the sideline. So even if they lose that, well, I mean, they're putting their cash in money markets and collecting 5% as of now. So if the Fed doesn't cut, Apple still goes higher because they can grow revenue. Amazon had a nice break out of that trend, out of that consolidation yesterday. And then diving a little, let's see if there's any opportunity here. Probably, I never really liked Amazon's price action. I mean, this was probably the best bet you had. But if you do get a pullback into that support, then that might be a nice play if you get a support and then a hold above VWAP. So, you could get that pullback. May not go this far, but maybe 150. You get a hold above VWAP, and then your stop is below, right? It either goes higher, goes lower. It is what it is. Back to the daily chart. And Dimaj, we'll check out Cooler Technology too. We'll take a look at Cooler Technology as a micro cap play. All right, Google, and my thesis is we are going into a new secular bull market. So I think swing trading is going to start to pick up. I'll start to do a little more technical analysis now that the market is, pretty much the cycle is lifting. We're reaccelerating the cycle. This is nice. So Google has a large wedge pattern, pretty big wedge pattern. Just want to catch that momentum. The RSI is not too far up, so this has room to really break out at some point. Who knows when? But just watch NASDAQ. As NASDAQ gets to all-time highs, Google should start to really break out. If we dial it in a little closer, let's see, where's our resistance? 140. You got some resistance at 140. You got some support here at 136. Oh, it did close the gap. So it closed the gap here at 136. And then you have that resistance at 140. Yeah, but Google looks good. And I think Facebook is breaking out, or Meta. I'm pretty sure Meta is breaking out pretty nicely. Meta just slowly climbing up, starting to get more vertical. Very bullish here. Let's see what that volume looks like. Yeah, 3 days of green volume. I mean, a lot of people might chase it. I know there's people waiting, but if it does pull back, I think it's just, everybody's going to buy the dip. Everybody's going to buy the dip because where the Fed is at right now, where the Fed is at is very constructive for stocks. We're in Goldilocks, productivity growth with lower inflation. Microsoft forming a wedge pattern. falling wedge. This is very bullish pattern here. Very bullish setup for Microsoft. I still think it might have some room to come down a little bit, maybe 360, 362, and then start to burst out. They're the leader in AI at the moment, so that's what you got. Would you say here? Where do you see in phase going? I'm about to trim. Okay, you're gonna trim your in phase. We'll take a look at in phase. Dimaj, take a look at in phase here. Let's see, where do I got in phase on here somewhere. Oh wow, in phase is getting vertical. You sure you want to trim there? It's starting to break out. Let's clear this chart up and then we'll chart it up. You know, the funny thing is, in phase they did lay off. They lay off a lot of workers, right? They reduced their cost structure. This is very bullish for the stock. A lot of people think layoffs is bad, but typically in this type of environment, this is why macro is important. It helps you to understand where you at. What are the market conditions? Are you in winter? Are you in summer? Are you in spring? Are you in fall? Where are you at? Well, we left fall and winter. We're now in early spring because the macro cycle is starting to pick up. We're re-accelerating the macro cycle, but it is overbought there. But check this out on the big trend for in phase. And I know it's scary. It's like, oh, in phase has been dropping. I need to get out a little bit. Trimming is not bad. Of course, you can trim. It's always a good idea to trim, let the rest run a little bit. It's had a nice rally here. But in phase is breaking that downtrend for the first time. And I mean, it's been in this downtrend for a while. So in phase is breaking the downtrend. See with the moving averages, very vertical. You're getting you're starting to see that. Let's point it out here. Getting the golden cross, 50 above the 100, 50 above the 200, triple golden cross, a lot of momentum here, and the 100 above the 200 moving average. So I always say, hey, I want to see a spike, a pullback into the trend and also into that moving average. So let's say the 50 comes up here. I want to see a spike down. And while momentum is picking up and you get a nice pullback support off low volume, that's always nice. You said the audio is off. It's the reason why, if you guys are on Instagram, so StreamYard, I'm using StreamYard and it has a lot of bugs. They just integrated streaming on Instagram, so it is probably off. I'm sorry about that. I can't do anything about it because they need to fix the bugs. So hopefully there's a lot of people communicating to Instagram that, hey, you guys are, there's a lot of bugs. But I'll try my best to make it clear. If you have any specific, now is on, your audio is off. Really? Audio is off, huh? What? But I'll try. If I turn the audio on, then it echoes. So I don't know how to figure this out. But if I do turn it on, you can hear me. Yeah, I don't know. That's weird. I thought you guys would be able to hear me. So Instagram Live, you can't hear? Now it's working perfect. Let me know if it went back off, because the problem is if I do throw on the audio, I had no clue it wasn't working. If I do put the audio on, it echoes through the YouTube stream. It echoes everywhere else. So let me know if it does come back on. That's unfortunate because I can't turn it on. I thought you guys could still hear me. I thought it was just the output. So I don't know. That's why I hate technology sometimes. Anyways, yeah, in phase. Should you let it run? Should we let in phase run? Well, rates are coming down. In phase is very bullish at the moment. And yeah, I guess it depends on your positioning, right? Wherever you're positioned, maybe you want to get in something else. You could let in phase run a little bit. It looks good to me. Looks good to me. All right, so that's in phase. If we go to the weekly, let's say what it looks like on the weekly. We should have actually started here. So Dimaj, look at that 200 moving average coming in at 144. So you're close to that 200 moving average. It would make sense to trim a little bit. It's had a nice run, but also on the weekly, you can see the RSI still has a lot of room to go up. So, I mean, it's up to you. Still has a lot of room on the weekly. And now that we're swinging in the macro, I think it goes higher. I think it has a lot more room to go. But again, sometimes you're holding that bag for a while and you're like, all right, I just want to get out and let the rest run. I'm okay with that. And if you're okay with that, that's fine. What up, Hassan? What up, Hassan? All right, so let's go back to where we Netflix on the weekly. Let's get rid of some of this. Netflix turning bullish again. Very strong trend. I don't know if anybody messes with Netflix. I don't really mess with it. But I mean, this should be is this a Mag 7 stock? Not really, but I'd still put it up there. They're just getting disrupted a little bit by Apple and Amazon and Google. They're being disrupted by a lot of other names, Hulu, whatever it is. Netflix probably still has the market share, but they could be disrupted if they don't innovate. And actually, before we get to Tesla, let's go to NVIDIA. NVIDIA is nearing a breakout point, and I think there's going to be a lot of FOMO in NVIDIA going forward. I think there's going to be a lot of FOMO here. I mean, this thing never dropped. It just never dropped. See what the daily looks like. Oh, yeah. Yep. You see those moving averages starting to consolidate? They haven't expanded yet. They've been last time it expanded was back in July, so the last bull market. I think NVIDIA, a lot of analysts I read are very bullish on NVIDIA. They're increasing their price target. The forward PE should be coming down. I think Qs just bursted right now. Qs are moving up right now. So NVIDIA, I think, man, NVIDIA has a lot of room to run here. Let's see what the fib looks like. Oh, that's not the fib. I always do that. So Fibonacci conservative looks like it could run a 540, maybe 575. I would guess it goes somewhere around 575. Maybe the next 3 to 4 months, because NVIDIA doesn't care about consumer spending slowing. That's the thing about the macro too, is keeping track of what is driving the market. And NVIDIA growth has nothing to do with consumer spending. It's all government stimulus, right? And that's not slowing down. You're getting the CHIPS Act. You're getting a lot of government spending in the chips area, and also Apple, Amazon, whoever needs AI, whoever needs LLMs or any type of model is going to be buying the NVIDIA chip. So their earnings are set to continue to move up. I think I have a chart. Yeah, I do have a chart in here on how elevated the earnings have been for NVIDIA. Look at that. Insane revenue growth. Insane revenue growth. That's their compute network, graphics or whatever. Graphics are pretty much at maturity level, but the potential for compute, cloud compute, well, it's compute. It's basically LLMs for language models for for AI. Everybody says that name. Everybody talks about AI, but it's just getting started. So I think they still have a long way to go here. A lot of that consolidation. They haven't really made new highs since August. So this thing should break out. This would be a nice swing trade. I got to keep my eye on it. Definitely got to keep my eye on it. It's looking better than Tesla. And then AMD, we said back here, probably had the best setup. We missed it. But AMD can climb. If it comes back down to this 50-day moving average, I might look at it, because AMD doesn't care. These chip companies they're not going to be tied to consumer spending, which is the thing that will slow. This is gaming too, so I don't see that happening. Let's see what else we got here. Asan, what up, Asan? I'm 100% up in TQQQ. Should I trim my portion or let it run more? Is that the inverse of the Qs? Inverse Q, you're 100% up on this is like an intraday trade or what? Not obviously I can't do a financial advice, but I think TQQ is or is it a leverage? Is it leveraged? Oh yeah, this is leverage, bro. And this thing is still pretty low. But it is following the Qs. It is following the Qs. Natural language processing, probably both. Large language models is what I meant for the chips. Large language models, and you probably also have natural language processing. Okay, so yeah, this is the yeah, bro. It's overbought. Like if you're doing a trade, If I were trading this, I would be getting out. I'd be getting out. It's up a lot. Let's see what, and I know the Qs are starting to break again. They just went into after hours at all-time highs. So kind of a bad timing. Let's see. Let's go to the 30-minute chart. Look what TQQ is. TQQQ. Take these off. I mean, if you get that gap up tomorrow, yeah, I think if you get a gap up, I would trim some and wait. It's pretty overdone, especially if you're holding the position, you might be okay, but it's up a lot on a trade. If I was up on this trade, I would be trimming it. I'd be trimming it maybe 75%, see if 25% can move, and then just go from there. But if you are on Instagram Live, let me know if the volume is working. Let me see if the comments work. This thing has bugs in it. No, it still has bugs. I can't even type. Wow. I don't know why it's so buggy. I can't even type a sentence. Wow. Okay. That's fine. So yeah, TQQ, all-time highs. I mean, you're just looking at the Qs. The reason why I would to kind of look at this as to cover, I mean, look at that. Would you look at that? That's a big move. And you're really just looking at the Qs too. So the Qs could rip higher for sure, right? They are at all-time highs. And my guess is, let's see, what do we have tomorrow? Anything major? We just have housing activity tomorrow. So the Qs are strictly going to move off of this. Maybe this will inform your trade decision. The Qs are going to strictly trade off of, because there's no real data coming out. The Qs are going to, our NASDAQ is going to trade off of dollar and rates. Dollar looks like it is falling, right? Back down to 100. So this could keep running. And then if you look at, and it depends on where your expiration is too, if you're trading options. But look at rates. Rates look like they're going to fall off again because there is no expectation of accelerating growth in Q1. That growth is going to be stagnant. So these rates should continue to fall, which plays right into the Fed's expectation or the projections, which is slower growth in Q1. So TQ, I would still cover though. I mean, the market is over. The market doesn't really care too much about. It does care about the macro, but when you're positioned, when the market gets over positioned like this, you're going to get a pullback first. So you might get a pullback to that support on the Qs. I wouldn't even watch TQQQ. I'd be watching the Qs. Maybe you get a pullback in a 47.50. Maybe you don't. It could just keep moving, but the gap up tomorrow should really give you some nice profits either way. All the negative press is not stopping Tesla. I know a lot of negative press on Tesla, and it's still chugging higher. Very true. Oh, well, the blah, blah, blah. Look, the fact of the matter is those elevated rates. So here's how I'm thinking about Tesla. We'll go ahead and move over to Tesla. The way I'm thinking about it is, and I'm swing trading it. I'm not day trading, so this is not going to be the same. And this is not financial advice. This is strictly for entertainment purposes only, and education. So the way I'm looking at it is they've tried to push the price down so much, and we got above that level. We supported that level, that previous level. Here was my resistance. We got above that resistance, turned it into support. I guess we can get rid of this. Maybe we could come back down here. I'll keep it on there for now. But the way I'm thinking about it is January 1st is production numbers. I think they're going to crush production numbers. And you hear a lot of, EV sales are not very strong. There's not a lot of demand for EVs. Well, when you look at GM, Ford, whoever else it is, Stellantis, yeah, their EV sales suck, but Tesla's EV sales are climbing. That is not the case for Tesla. And as rates start to be, as borrowing rates, not borrowing rates, but as refis, as the debt has to be refinanced for GM and Ford, which Tesla doesn't have any debt, well, they're gonna really have to stop their operations. So I think Tesla really starts to swallow the other companies, and it could make a run like it did in 2019, where the S&P is kind of stagnant, Qs are stagnant, but Tesla keeps moving up because the shorts get squeezed, and it's pretty clear the rest of the industry cannot survive. The rest of industry cannot survive. And it is breaking. I know that's in the way. Let's remove this really quick. Guess you can't remove all of it. It is breaking. Let's go to this chart. It did drop out of this trend and then it came back up. So little short dip, but it is trending up. This looks really good. Now it looks like looks like we're in a wedge. Looks like we're starting a wedge here. Just riding it up. That's a lot of buying right there. Pretty good buying pressure. See the volume coming in off of that sharp rally, squeezed everybody up. They had to cover. So I think Tesla's at a breakout point. I think it's at a breakout point, and it could be tough, but that 253, 254 level's been holding, 252, whatever it is, and we're breaking out of this long-term trend. And the fib tells us that we should be headed for 365, somewhere between 365 and 400 on that next move. I'm thinking it happens going into production numbers, right? It's going to expect better production numbers while the other OEMs or the other EV companies, their production numbers are falling. Or I'm sorry, deliveries, my bad. Delivery numbers are falling. So I think we get that run up. I think this is going to be a nasty upside move for Tesla going forward. And let's go to that daily chart really quick. Yep. You got a nice uptrend. Let's go ahead and take the fib off. Next resistance is around 260, 265-ish. We could even gap up and run tomorrow into that level. 265, 278. Close that gap at 290. So still a lot of room to run, but it's basically, broken the big downtrend that started in not just the one from summertime, but we're talking the large, big downtrend. We're out of that downtrend. Unless you do this, but I mean, I'd say we're out of that downtrend now. Looking pretty solid for Tesla. Let's look at the intraday. How did we trade today? These institutions are crushing people. Big fake out yesterday. I got faked out here too. I got faked out. I think I added here and then dropped VWAP. I got out, I added again, dropped VWAP again, and I took some off. And then I got back in today, about right here on this breakout. And I think, did I add again? No, I don't think I added again. I'm just waiting. I want to see a really good pattern. Typically, what I want to see for Tesla going into tomorrow or the rest of this week, because I think what's going to set off the market to all-time highs is going to be that GDP on Thursday and Friday. GDP and PCE, Fed's preferred inflation gauge. So I am looking for this type of pattern. Let's say we gap up. Let's see, would it be a gap up? Yeah, I think we could gap up. Let's say we gap up above. If we gap up above 258 and we open, I mean, that's going to be nasty. I'm always saying this. If we do gap up here, you're going to get a pullback and then it just goes. Maybe the 3 minute, the 1 minute might shake you out, but look at the 3-5 minute. We should go. And then I want to see this. I want to see a little wedge. We haven't had many wedges in this market. There really hasn't, but boom, you get that big move and then you form a wedge. That's my play right there. A nice wedge. And sometimes it breaks down, but if it breaks down right into VWAP, that's your move right off VWAP. And then there it goes, boom. So I'm waiting for it. I'm waiting for the kill. Oh, shoot. I don't know if I can say that. My bad. I'm snipering this thing. Waiting for it. Just staying patient because I still think this is the best play in the market. outside of Nvidia, and yeah, I think outside Nvidia, because Nvidia could get pretty elevated. Their earnings are insane. Oh, you guys can hear me on Instagram. Okay, maybe it was that guy's volume then. Maybe it was that guy's volume. Thanks for the feedback. And sorry, I cannot type on the Instagram. This is, look, if I say hi, look how it comes out backwards. It does it back. For some reason, there's a bug in the system. So hopefully they fix that. Bear with us. Until now, I'll just be talking. Dimaj says there is no resistance on Tesla. It's going to do a great job. Yep, I agree. What else we got? Tesla will grill the bears and shake out weak hands. The rest is history. Yep, just got to get that entry. Just got to get a solid entry there, because the theta will eat you up on the options. Much safer to trade shares, but the theta will eat you up on options. And we're slowly making lower highs, though. Okay, we're making lower highs. Here's your low, low, lower high today. We might get that gap up tomorrow. I kind of want to stream early, but I don't want to mess up. I want to stay focused on it. I'll start probably streaming trading in January. I want to finish the course first, the course for the macro fundamentals, and all that information before I move on to trading, because I do plan to do that, getting back into it. But I don't want to do 10 things at once, because that will mess up your trading. You got to stay focused on trading. All right, so yeah, that's Tesla. Look at that. Look at that area. I mean, this is another wedge. Last time we moved up 100%. So this 100% move actually would take us to like 470. Now the market's a little bigger, but once you get those shorts, I think you can come up here. And it's not going to be a straight ride. It's going to be volatile. But you really got to watch that momentum. Watch the R-vol. Watch the R-vol. I think Teladoc also had a big move today. I'm watching this. I need to dive into the fundamentals. I know the options chain is really, really good. Like the option gamma is insane for Teladoc. But, I just don't know about their earnings. Earnings come, February? This could be a play if it breaks out. Now that rates are coming lower, a lot of these interest rate sensitive names could really break out. CVNA. All right, I see you. Oh, I already got it on here. CVNA. Oh, CVNA. It is setting up. Yeah, it is setting up. This might be a massive breakout. Let's look at the short float really quick. Let's check out the short float, because Carvana, I remember when I first started streaming, we were back here and I was like, this thing could squeeze. It squeezed and I was like, I don't know. Boom, squeezed again. Just nasty price action. Now you have a reverse head and shoulders. I mean, this is the pattern you want to see. Big macro reverse head and shoulders. So it doesn't get any clearer than that. And this is what? This is a interest rate sensitive stock. So you have the fundamentals behind it as rates come down, not the Fed rates. We're talking about bond yields here. As bond yields come down, they're also using AI. They're cutting their costs. But the fact that earnings aren't till February should be nice. Let's see. Okay, let me open up let's look at can you look at it on here? You might. I don't know how to do it on here. I never use this. But there is a way to look at the short float. Maybe I should try it right now. See if I can do it without messing this up. Let's go to... No, I'm not going to do it on here. I don't want to mess up. I don't want to mess it up. I got to get used to it. I need to learn how to look it up on there. I'm going to look it up over here, the short float. Because if the short float is still pretty high, you're going to get a nasty short squeeze on Carvana. And I'll walk you through how I look at it on FinViz. I usually use FinViz. CVNA. JNCom, what up? Let's see. So short float, short interest is right here. It's a little delayed. Wow, why am I so delayed? That's weird. This website's full of ads. That's why. All right, so short flow is 34%. That is a setup for a short squeeze. That is a setup. 34% of the shares are shorted. So man, this might be a nice breakout. Looks like it's breaking out on this chart. What was the R vol today? 2. You get that R vol up to like 4 or 5, the shorts are going to cover. So CVNA, yeah, nasty short float, pretty small market cap. Come on. And it is starting to peek out of there. Let's zoom in a little bit. Yep, gapped up today. 30-minute chart. Nice gap up. Let's look at I'm going to see it on here. Okay, yeah, nasty. Look, it's already squeezing. That's a squeeze move. It's been squeezing. So Carvana can have a nice squeeze. I'm not going to say how to trade it because I haven't traded Carvana. But it does look like it has that squeeze potential. Just look at where it does start to move up. Typically, something happened midday over here. I don't know what this was. They probably announced something. December 13th. Oh, no, duh. What am I saying? This is the Fed meeting. That was a Fed meeting. So it's been squeezing the shorts. And this is your level for Carvana. For tomorrow, I think it's probably going to gap up at this point. Probably gaps up. Get a pull and see, it doesn't really respect VWAP. This is why I don't like it. It doesn't respect VWAP. It just gets destroyed. Maybe you play RSI on it. Let's go to the 30-minute. See what it looks like on the 30-minute. Maybe you play some RSI here. This is a tough one. Let's go to the 5-minute. Might want to play the RSI. Is there any divergence here? A little bit. I'd play the RSI divergence. See, RSI starts to bottom out. Kind of 1 for 1. No clarity. It did respect VWAP back here, so maybe there are some institutions in there. You got some bearish divergence. Yeah, Carvana. Yeah, I don't know. Well, it does look good. That thing's gonna explode when it gets going. Yeah, it's gonna run. It's gonna run, especially with this outlook. And it's already gapped up, so that's about it, man. It's above resistance. It is above resistance. Carvana. Good call there, bro. Let's see what else we got here. Teladoc Zoom. I'm debating. Let's go back to the bigger charts. I'm debating whether to take a look at Zoom. Where is it? I might just wait till it gets above and supports. Might have to wait for this. It's been up a lot. Let's see. What'd you say? Dimash Carvana escaped from our hands. Oh, yeah. You remember that back in the day. Pfizer is a great entry point plus dividend. Okay. Pfizer. I never liked Pfizer because it doesn't move much, but as an investment, it should do well. Thoughts on DHI? What is Pfizer anyways? What is it? PF? PF? No, PZ? I can't remember the ticker for Pfizer. But if you want to look at the macro, look at a biotech. This is the biotech ETF to help you if you do trade Pfizer. I don't know. I wouldn't trade Pfizer, but the bio ETF, I see you, TLT, the biotech ETF, that's a good call there too. Is going to give you some insight. It's like watching the NASDAQ or the Qs, right? For a tech stock. You watch the Qs if you're trading big tech. If you're going to trade Pfizer or a healthcare / biotech, then you want to take a look at IBB or XLU. No, XLV. Yeah, XLV healthcare. But I would say Pfizer's more of a biotech. Dang, healthcare is just in the zone. DHI. Let's go over DHI and then we'll hit TLT. What is this? DR Horton. What do they do? DL Horton. That thing is moving. Okay, RSI pullback. Looks like some bearish divergence. Let me see what that looks like on. It looks like it's going to come back into that 50-day. I would just look at that. Had a gap up, kind of consolidating. Could come like as it consolidates, watch this 50 moving average climb back to that gap. I'd watch it climb back to that gap. Let's see gaps. See if this is working. Yeah. Gap at what? 144. I think it would be nice at 144.40. You got that gap fill. Also, you have the 50-day coming up into it. So check that out. I mean, I would keep my eye on that for DR Horton. If not, it comes probably back down here. Who knows? But looks strong. I don't know the fundamentals, so I don't know what the fundamentals are. But it looks pretty good. TLT. TLT. TLT is at a resistance. So my view on TLT, it's going to make a move eventually, another move. It is getting into that overbought territory, but let's clear this out. Let's clear this out. It is getting into overbought territory, but I think this is all going to come, and this one's pretty easy for macro. If growth comes out lower, this is going to break out on Friday. So check this out. If you're looking at TLT, this is key. TLT is a macro asset, just so you know. It's a macro asset. It's going to focus on the economy. It's not like an individual stock, right? It's an ETF. So what you're looking for is, I don't know if home build, I don't know if this really moves it, but it's going to be Thursday. Thursday, let me see what we got. This is Wednesday, Thursday. GDP growth rate quarter over quarter. If this comes in lower than 5.2, it could move up. If it comes out much higher, TLT will not move up. It'll probably sell off a little bit. Continuous jobless claim. So any sign of weakness means TLT is going up, or it should catalyze it higher. You might get that in the Fed employment, but I think Friday is a real day. So also growth comes down, but if core inflation is down, you could get another rally in TLT maybe Friday. You get a rally as this comes out very early before the market opens. Core PCE is set for 0.2%. Anything lower, TLT booms. Durable good orders, anything lower, TLT booms. And this is all an aggregate. There's not one indicator. Personal incomes, personal spending. Personal spending might be up though. PCE month on month, 0%. That's really good for stocks. Wow. PCE year over year coming in at 2.8%. That's so bullish. So if these inflation numbers are lower, TLT is going to go up. There's just a lot of demand for fixed income. So if it runs, it probably breaks out on Friday. That's my guess. But yeah, TLT is not a stock, so it might be it might be an ETF, but it's going to move based off economic data and policy. Doesn't have earnings or anything. What site is that? That is tradingeconomics.com. And just go to the calendar. Tradingeconomics.com, go to the calendar. I'll probably tweet something out on Friday. If you want to follow my Twitter, it should be in my bio for Instagram, but I'll probably tweet out what numbers you want to see to get equities going and to get TLT up again. You're welcome. Pfizer made massive profits for the COVID vax. Now it bottomed. And you never gave me the did you give me the ticker for Pfizer? I don't think so. I'd rather be in Teladoc. This is a healthcare play, and it's down a lot more potential. They have the most data, and they're not profitable yet. But with interest rates projected to come lower, that's where investors really like to get get some beta, and Teladoc has that beta. If ARC breaks out, it goes higher. Check up on Square. Dang, this thing is straight up. Let's get back to the weekly. Square coming into resistance. SoFi. Wow, SoFi is breaking out. SoFi can have a massive move higher. Always look on the Fibonacci's. I always like to look on the retracement. I like to look at the mid between 1.618 or just say blue and red, somewhere in the middle. So this could pump to 18, could double. It's not a double. Could go to 18 on this next run. Let's see. The last fib gave us right there, right above blue, a little above the 1.618. So that's why I like that. That's how I use the fib anyway. There's a lot of ways to use technicals, but I'd use it like that. KULR. No, Cooler. Should we hit Cooler Technologies? Take a look at Roku. Roku's coming into trend. Roku is just weird, man. Roku is weird. You got to catch it getting smashed. Palantir. I hope it just ranges. I want to get into this later. Okta looks good. A lot of consolidation there for Okta. Open Door might do good now because interest rates are down. The housing market's picking up. They could, they're not going to lose as much money as they were. They are losing a lot of money. But Open Door looks pretty solid. Airbnb is probably doing better. I like CRISPR as gene editing. Oh, finally, I didn't see it. It filled that gap down there almost. CRISPR gene editing. This is the number one, in my view, the number one gene editing technology. CRISPR Therapeutics. Teladoc undervalued? Yeah, I think Teladoc's undervalued too. It's undervalued. You just need lower rates, to fund that growth. So, I mean, as long as inflation keeps falling, I think Teladoc does well. Now, I am watching this beast right here. I've been watching this for 3 years. Very small. It's a micro cap. It's 38 billion market cap. Very small. Dimaj knows what's up. Looking at the fundamentals, pretty good fundamentals for a micro cap. It has a use case. Total addressable market is 400 billion. Energy storage, and also aerospace is starting to pick up. Everything that transitions into a battery, they have software technology for batteries. NASA's been using them for like 10 years, and they went public. 2021 they went public, and they just need more contracts. They need more contracts. Their revenue growth is picking up. So this would just be one little micro play. And I mean, with that small of a market cap, I mean, we're talking, if it goes to 300 billion, that's a 10x right there. If it gets to a billion market cap, 1 billion, which is still a small cap, I mean, that's a big run there. I usually don't do these, but I do understand the fundamentals on it to some degree. Not financial advice. I have a very, very, very small position. I'm waiting for the technicals to really turn. I'm waiting for that bullish divergence. It's starting to come in, and then I'll start scaling in a little more. Yeah, we'll see. Lower rates is good though. Needs to break out of this trend. Needs to get out of that downtrend. All right, let's turn to crypto. See how crypto's doing. Start with Bitcoin. False breakout. Bitcoin false breakout on the daily. And this is good. The RSI normalizing is really good. Crypto can still move off this 50% relative strength. right? It can still move off that. It's all about the ETF. Comes January. The question is, does it run up into the ETF, then sell off? Or does it break down and then wait for the ETF to get past? That's the real question. We haven't got any clarity yet because price is just consolidating. But that is a wedge forming. Bitcoin has the nicest price action. Other cryptos are pretty wild. So it did try to break out, came back down. Very normal for crypto. Technicals don't work the best for Bitcoin. It has a lot of momentum. Too much momentum. But again, like I said yesterday, everybody's like, oh, crypto is not doing so well. I'm like, bro, Bitcoin from the lows literally 1 year ago. 1 year ago, Bitcoin is up 175% from a year ago. Solana's up like 800%. Chainlink's up. See where Chainlink's at. I still want I expect Chainlink to outperform 181%. Dang, it's up as much as Bitcoin. Come on, this needs to get up a lot more than that. At the highs, it was up 250 though, right? 250. So this thing pulled back a lot. This is by far my favorite crypto. I think it has the biggest use case. If you're new, Chainlink Oracle Network. You basically have the largest institutions adopting this. DeFi doesn't work without it. There is no decentralized finance without Chainlink's price feeds, without Chainlink CCIP. And now they're bringing that to the tokenization of all real world assets. And they're building a decentralized computing marketplace. They're the most advanced by far. Swift is using them. BNP Paribas, a big European bank, is using them. Regulatory institutions like depository trust institutions are using them. ANZ, Australian Central Bank, using them. Well, not central bank, commercial bank. So Chainlink, I think, has the most use case when it comes on. Just a lot of people don't understand how it works. They think it's just a couple things, but keep, just stay tuned. This thing is going to boom. I mean, most cryptos will boom, but when the excitement comes, all tokenization, you heard Larry Fink, tokenization of all real world assets is only happens with this technology, CCIP. They also have zero knowledge proofs. So that's looking good. You got the graph pulling back a little bit. Indexing protocol, number one indexing protocol. What else we got? ETH to BTC still kind of rolling over. Where's Ethereum at? Ethereum consolidating. Man, we might see consolidation all the way till January. That's also, we could see that. We could just see this consolidation all the way through January 10th. I think that's when they have to pass the ETF, then big move to the downside or the upside. But either way, it's up from here, right? It's up from here. How much is ETH up from the lows? 144%. Man, Bitcoin really is leading the rally. I think my view, I think we see 10 to 18K ETH this cycle, depending on the macro, all determined by the ISM. All determined by the ISM. All right, we're at 128. Appreciate you guys joining. And just want to keep in mind, as we go forward, you're going to hear, I don't want to say you're going to hear, but we're in a new secular bull market. The underlying economic trends are telling us that. ISM new orders, leading momentum indicators. The housing market should be recovering now outside of a black swan. So if we eliminate the black swan from happening, we can't do that. But outside of a black swan, which is a big surprise to the market, growth is picking up based off productivity growth, right? We're getting more growth without inflation. Inflation is done. The Fed is done hiking. Profit margins are rising. We should get a slowdown, but we're slowing down into an economic cycle. I'm sorry, an election cycle. So we'll get, what is it? 65% of the stimulus in Europe hasn't hit the market, hasn't hit the economy yet. That's coming, especially during election. US is going to get that. And everybody's worried about, well, if they spend more, then the deficit gets bigger. Well, if the Fed cuts rates, the deficit goes down. And the Fed might cut rates in March, April, May. Not all three in a row, but they start cutting rates at some point because inflation keeps falling. It should be at 2.8% on Friday. Very bullish for the market. So I think Friday is the breakout. I've been calling it for a while, not to brag, but I still think Friday. We've had big moves on Thursdays and Fridays. So tomorrow might be sideways, and then Thursday, Friday, I think Qs go to all-time highs and finish much higher. So we'll see how this plays out. Either way, you guys stay blessed, eat well, lift weights, get healthy, learn something new, and tell somebody about something. Read, write, do whatever you can, improve yourself the best you possibly can, and enjoy the holidays. Stay safe out there and stay blessed. I'll catch you guys tomorrow. And I'll let you know if anything changes during this week. I will be traveling, so it'll be a little different stream. But anyway, stay blessed, guys. Catch you later. Thank you.